I called this move to $89 silver. Physical disappeared, bottom or retest lower. I called this move to $89 silver. But what happened next wasn't supposed to be possible. The price hit the target. Then the metal vanished, not from vaults, not from exchanges, from the entire physical market. Mints closed, refineries backlogged, premiums exploding to 20%, while paper silver trades at $85. So Shanghai is paying $100, a $15 gap that shouldn't exist in functioning markets. The question isn't whether silver reached $89. The question is, why can't you buy it there? And what comes next when price discovery stops working? Welcome to Metal and Macro. If you've been watching markets long enough to remember when a handshake meant something, when due diligence wasn't optional, when strategic thinking wasn't replaced by algorithms, then you understand why we're here. This channel exists for those who plan in decades, not trading sessions. If that resonates, do an old-fashioned favor. Subscribe. Not for the algorithm, for the community of serious thinkers who still exist. And tell us, from which corner of the world are you watching this unfold? Drop your location below. Let's see how global this awakening really is. On April 3rd, 2025, silver crossed $89 per ounce. For most people, it was just another number flashing across a screen. For those who understand how markets actually function, it was something else entirely. It was a warning signal that the machinery of global finance had begun to malfunction in ways most economists refuse to acknowledge. The analyst had called this move weeks earlier, not through speculation or guesswork, but through careful observation of patterns that had been building for months. Technical charts showed a structure forming, a compression of price action that typically preceded significant moves. But what happened after silver reached $89 wasn't just significant, it was unprecedented. The metal disappeared, not metaphorically, not in some abstract financial sense. Physically, actually, gone. Bullion dealers across 3 continents reported the same phenomenon. Inventory that should have been readily available simply wasn't there. Phone calls to refineries returned the same answer. Backlogged for weeks, possibly months. Mints that had operated continuously for decades suddenly went dark. No new production, no estimated restart dates. And here was the peculiar part that made seasoned traders pause. Normally, when prices rise sharply, supply increases. Sellers emerge. People who bought at lower prices take profits. New production comes online. The market balances itself through the most basic mechanism in economics, supply meeting demand at a clearing price. This time, the opposite occurred. As price climbed toward $89, physical availability decreased. Premiums, the amount buyers pay above spot price for actual metal, exploded. In some markets, premiums reached 18% to 20%. In Singapore, a major bullion hub, dealers reduced minimum purchase requirements, not because demand was weak, but because they were rationing limited supply. The analyst documented another anomaly that mainstream financial media completely ignored. While Western exchanges showed silver trading at $85, the Shanghai market was paying $100 for the same metal, a $15 spread. In normal markets, such a gap would close within hours through arbitrage. Buy in New York, sell in Shanghai, pocket the difference. Basic market mechanics. Except the gap persisted, day after day, week after week. Why? Because there was no physical metal to arbitrage. The paper price and the physical price had decoupled. They were now operating in 2 different realities. This wasn't the first time silver had rallied sharply. In 1980, the Hunt brothers drove silver to $50 before the market collapsed. In 2011, quantitative easing pushed silver to $49. In 2020, pandemic uncertainty triggered a spike to $30. Each previous rally followed a predictable pattern. Speculative buying drove prices up. Sellers emerged. Markets corrected. Prices normalized. But 2025 was structurally different in 3 critical ways. First, the supply chain itself had fractured. Years of underinvestment in mining, refining capacity strained to breaking points, and geopolitical fragmentation had created bottlenecks that couldn't be resolved with higher prices alone. Second, the nature of demand had shifted. This wasn't just speculative fever or inflation hedging. Industrial users, solar panel manufacturers, electronics producers, electric vehicle companies, were competing with investment demand in ways that hadn't occurred in previous cycles. They couldn't simply wait for lower prices. Their production lines required physical metal. Third, and most significant, was the monetary context. Silver had always occupied a strange dual position. It was both a monetary metal with thousands of years of history as money and an industrial commodity essential to modern technology. This duality meant silver responded to both monetary stress and industrial demand simultaneously. In early 2025, both forces were accelerating in the same direction. Central banks across the world had exhausted conventional monetary tools. Interest rates had been manipulated for so long that their signaling function had broken. Currency debasement was no longer a controversial theory discussed by fringe economists. It was visible policy, announced openly, implemented deliberately. When the analyst examined the $89 level technically, he recognized it as more than just a price point. It represented a confluence of resistance levels built over months of trading, a zone where, historically, sellers had emerged and rallies had stalled. The question now facing every investor, every business treasury manager, every strategic decision maker was simple but profound. Was $89 the top? Had silver exhausted its move and would now correct lower, potentially retesting support levels in the high 70s or even lower? Or was $89 merely a pause, a brief consolidation before the next leg higher into territory that would force a complete reassessment of what silver actually represented in a monetary system under extreme stress? The disappearance of physical supply suggested an answer that most weren't prepared to consider. In a small warehouse district outside Zurich, a refinery manager stood in front of empty storage racks and tried to explain something that shouldn't have been possible. His facility processed roughly 180 tons of silver annually. For 23 years, they had maintained a consistent inventory buffer, enough raw material to keep production running through typical market fluctuations. Supply chains had hiccups, certainly, but never complete failures. Until March 2025. By the first week of April, his storage racks held enough silver to run production for exactly 4 days. Orders were backed up for 11 weeks, and the phone wouldn't stop ringing. He wasn't alone. Across Perth, Australia, a major mint that had operated without interruption since 1899 posted a notice that would have seemed impossible just months earlier. New orders suspended indefinitely due to supply constraints. No estimated reopening date. No explanation of when normal operations might resume. In the United States, the situation had become even stranger. The U.S. Mint, a government institution, announced limitations on Silver Eagle production. Not because of labor issues, not because of equipment failure, because they couldn't source enough silver blanks from suppliers. The suppliers, in turn, couldn't source enough refined silver from smelters. The smelters couldn't get enough feedstock from miners and recyclers. The entire supply chain had seized up like an engine running without oil. What made this particularly noteworthy was the price context. Silver was trading near all-time highs. In pure economic theory, high prices should have triggered a supply response. Miners should have increased production. Recyclers should have processed more scrap. Holders should have sold into strength. Instead, supply contracted further. The analyst began mapping the breakdown with forensic precision, tracing silver's journey from ground to vault. Stage 1, mining. Global silver production had been declining since 2016, not because reserves were depleted, but because most silver comes as a byproduct of mining other metals, copper, lead, zinc. When those base metal prices struggled, silver production fell regardless of silver's own price. New mine development required 7 to 10 years from discovery to production. There was no quick supply response possible. Stage 2, refining. The refinery bottleneck was more complex. Decades of consolidation had reduced global refining capacity. Environmental regulations had closed older facilities. New refineries faced years of permitting processes. The refineries still operating were running at maximum capacity, but maximum capacity wasn't enough to meet demand that had suddenly doubled. Stage 3, minting and fabrication. Even when refined silver was available, converting it into bars, coins, or industrial forms created another bottleneck. Mints operated specialized equipment that couldn't simply scale up overnight. Adding production capacity meant ordering machinery with 12 to 18-month lead times. The supply chain wasn't broken at one point. It was fractured at every point simultaneously. But supply was only half the equation. On the demand side, something unprecedented was occurring. 3 separate buyer categories were competing for the same limited physical metal, and none of them could afford to wait. First, industrial users. Solar panel manufacturers alone were projected to consume 185 million ounces in 2025, nearly 20% of total global production. Electric vehicle companies needed silver for every car produced. Electronics manufacturers couldn't build circuit boards without it. These buyers weren't speculating. They couldn't substitute other materials easily. They needed physical delivery to keep production lines running. Second, investment demand. But not the typical retail rush during previous rallies. This time, pension funds and sovereign wealth funds were entering positions. These weren't traders looking for quick profits. These were institutional allocators making strategic decisions with decade-long time horizons. When a $50 billion pension fund decides to allocate 2% to physical silver, that's $1 billion competing for metal in a market that only produces $25 billion worth annually. Third, and least visible but potentially most significant, strategic national stockpiling. The analyst had documented something curious in Chinese import data. Official numbers showed silver imports declining, yet physical metal in Shanghai was trading at persistent premiums. Where was it going? Unconfirmed reports suggested government-level accumulation. Not through central bank announcements, but through state-owned enterprises and strategic resource agencies. Similar patterns appeared in Indian data, and Russian trade figures showed anomalies that suggested non-commercial accumulation. If governments were quietly stockpiling silver as a strategic resource, both for monetary purposes and industrial security, it would explain why physical metal was vanishing at any price. The premium explosion told the clearest story. In Singapore, premiums reached 18%. In parts of Europe, 22%. In some retail markets, buyers were paying 25% above spot price just to secure physical delivery. These weren't normal market conditions. These were stress signals indicating that paper price discovery had become completely disconnected from physical reality. The analyst examined one more data point that sealed his analysis. COMEX warehouse stocks, the physical silver backing futures contracts, had been declining for 18 consecutive months. Every month, more silver left the warehouses than entered. The inventory that underpinned the entire paper trading system was being drained. At current rates of withdrawal, some analysts calculated the warehouses would face delivery failures within 6 to 9 months. What happened when a futures exchange couldn't deliver physical metal to contract holders who demanded it? No one knew for certain, because it had never happened before in modern commodity markets. The disappearance wasn't a mystery, it was a mathematical inevitability. Years of supply underinvestment had collided with surging industrial demand, accelerating investment flows, and possible strategic accumulation. The collision was producing something markets weren't designed to handle: sustained physical scarcity during a price surge, and this led to the question that would determine everything that came next. A technical analyst in London opened his trading platform at 6:47 a.m. on April 7, 2025, and immediately noticed something that violated 40 years of market experience. Silver had broken through $89 the previous session. By every technical indicator he trusted, RSI, MACD, Bollinger Bands, volume profile, the metal should have been showing exhaustion. Overbought. Due for a correction. The textbook set up for profit-taking. Instead, the chart showed something he'd only seen twice before in 4 decades. Both times preceded market dislocations that rewrote valuation frameworks. The price had touched 89.40, pulled back to 86.20, then stabilized at 87.50. Normal correction behavior. Except the volume during the pullback was unusually thin, and the recovery happened on declining volume. In traditional technical analysis, that pattern suggested weakness, a rally losing steam, sellers overwhelming buyers. But when he cross-referenced physical market data, the story inverted completely. Low volume wasn't indicating weakness, it was indicating scarcity. There simply wasn't enough physical metal available to create the normal selling pressure that volume analysis assumed would exist. The chart was lying. Not because the data was wrong, but because the assumptions underlying technical analysis had become obsolete. Every technical framework ever developed assumed one fundamental principle: that supply would respond to price, that sellers would emerge at higher prices, that markets would clear through normal supply and demand mechanisms. What happened when that principle stopped functioning? The analyst pulled up historical precedents, searching for comparable situations. He found 3 instances where technical analysis had failed in similar ways, and each one had redefined market understanding. March 1980, gold trading. Technical indicators showed extreme overbought conditions as gold approached $850. Every oscillator screamed, "Sell." Every momentum indicator flashed warnings. Traders who followed traditional technical signals got destroyed as gold continued climbing to levels the charts said were impossible. The flaw in the analysis? The charts couldn't account for Hunt Brothers' corner of the silver market and the resulting panic flight into gold. Technical patterns assume normal market structure. When market structure itself breaks, the patterns become meaningless. September 2008, credit default swaps on Lehman Brothers. Technical analysis showed oversold conditions. Mean reversion models suggested buying opportunities. Risk models based on historical volatility indicated the panic was overdone. Then Lehman collapsed. The oversold signals weren't buying opportunities. They were warnings that the entire system was repricing counterparty risk. The charts couldn't see systemic breakdown approaching. March 2020, oil futures. Technical analysis identified strong support at 30, then 25, then 20. Every bounce seemed to confirm support levels. Until April 20th, when West Texas Intermediate crude traded at negative $37 per barrel. Negative. The charts literally couldn't display what was happening because the possibility hadn't been programmed into the visualization tools. Now, in April 2025, silver was presenting a similar disjunction. The charts showed one reality. The physical market showed another. Which one was telling the truth? The analyst constructed a framework to evaluate the actual question facing every decision maker. Was $89 a top, or was it a way station? He started with Fibonacci retracement analysis, a tool that had proven reliable across decades of commodity cycles. From the breakout low of $24.80 in October 2023 to the current high of $89.40, he plotted the standard retracement levels. The 38.2% retracement sat at $64.72, the 50% level at $57.10, the 61.8% level at $49.48. In normal market conditions, he would expect price to test at least the 38% level during any healthy correction. That would represent a $24 decline from the highs, significant enough to shake out weak hands, but not enough to break the broader uptrend structure. But these weren't normal conditions. He examined volume profiles, the price levels where the most trading activity had occurred. Heavy volume at specific prices typically acts as support or resistance because it represents areas where large numbers of market participants have positions and therefore incentive to defend those levels. The volume profile showed something peculiar. Most trading activity had occurred between $72 and $78. This should have been a strong support zone. Yet when he examined physical market data, virtually no one was selling in that range. The volume represented paper trading, futures contracts, ETF flows, speculative positioning. Physical holders weren't selling at $78. They weren't selling at $85. They weren't selling at $89. This created a technical paradox. Chart support levels based on volume analysis assumed that participants who bought at those levels would defend them. But if most of that volume was paper trading and the paper holders couldn't deliver physical metal anyway, did the support levels actually mean anything? He pulled up the 2011 silver rally for comparison. Silver had climbed from $8 to $49 in 9 months, a 172% gain. When it topped, the correction was swift and brutal. Within 5 weeks, silver had fallen 35% to $32. Within 3 months, it was back to $26. The technical structure of that decline showed clear distribution, heavy volume at the top as holders sold into strength, declining volume on bounces as buyers disappeared, classic topping behavior that every technical trader recognized. The 2025 chart showed the opposite pattern. Volume remained relatively stable, pullbacks recovered quickly, and most importantly, physical premiums widened during price declines, indicating that real buyers were actually stepping in more aggressively when paper prices fell. The analyst then examined sentiment indicators, searching for signs of speculative excess that typically mark tops. Options. Market data showed elevated implied volatility, but not extreme speculation. Put-call ratios indicated hedging activity rather than pure directional betting. Commitment of traders reports revealed that commercial hedgers, the producers and industrial users, were actually reducing short positions rather than adding to them. In past cycles, tops occurred when commercial hedgers were maximum short and speculators were maximum long. The current positioning showed the opposite, commercials protecting against upside while speculators remained relatively cautious. Every traditional indicator said different things. Some pointed to exhaustion, others suggested continuation. The divergence itself was the signal. Markets don't produce such divergent signals unless they're in transition between two different pricing regimes. The real question wasn't technical at all. The question was whether silver remained a commodity governed by normal supply-demand economics, or whether it had entered a phase transition into something else, a monetary escape valve, a strategic resource, a physical hedge against system risk that no paper instrument could replicate. If it remained a commodity, then $89 was almost certainly a top. Technical corrections were inevitable. Fibonacci levels would hold, normal patterns would reassert. But if it had transitioned into a monetary phenomenon, then the charts couldn't tell you what came next. Because there was no historical template for what happened when the physical market for a monetary metal simply disappeared. The analyst closed his platform and reached a conclusion that violated everything his training had taught him. Sometimes the most important market signal is when your tools stop working. A treasury manager at a mid-sized manufacturing firm in Stuttgart faced a decision that had never appeared in his risk management playbook. His company used approximately 2,400 ounces of silver monthly in specialized electronic components. For 17 years, procurement had been straightforward. Place order, receive delivery within 2 weeks, pay spot price plus a modest premium, repeat monthly. In April 2025, his supplier called with news that changed everything. Delivery times had extended to 14 weeks. Minimum order quantities had tripled. Premiums had increased from 4% to 19%. And there was no guarantee those terms wouldn't change again before delivery. He could lock in supply now at elevated prices. Or he could wait, hoping prices would correct, risking production shutdowns if supply became unavailable at any price. This wasn't a question about predicting silver's next move. This was a question about understanding what kind of world he was now operating in. His dilemma was being replicated across thousands of businesses, investment committees, and strategic planning sessions worldwide. The macroeconomic context had shifted in ways that made traditional risk frameworks obsolete. For 15 years following the 2008 financial crisis, central banks had maintained one consistent policy: monetary expansion, interest rates near zero, quantitative easing measured in trillions, asset purchases that bloated central bank balance sheets to levels once considered unthinkable. The stated goal was always temporary: emergency measures to stabilize systems under stress. But temporary measures had become permanent policy, and permanent policy had created structural distortions that couldn't be unwound without triggering the very crises the policy was meant to prevent. By 2025, the distortions had reached critical mass. Government debt across developed economies exceeded levels seen only during world wars. Debt to GDP ratios that had once sparked sovereign crises were now considered normal. The United States federal debt approached $37 trillion, whereas Japan's debt exceeded 260% of GDP. European sovereigns carried debt burdens that would have been unthinkable 2 decades earlier. Servicing this debt required interest rates to remain suppressed. But suppressing rates required continued central bank intervention, and continued intervention required currency creation that steadily eroded purchasing power. The policy trap was complete. Raising rates risked debt spirals and economic collapse. Maintaining low rates guaranteed currency debasement. There was no exit that preserved the system's current structure. Sophisticated investors understood this equation. More importantly, so did central banks themselves. The analyst documented a pattern that had emerged over the previous 18 months. Central banks were quietly diversifying reserves. Official gold purchases had reached levels not seen since the 1970s. But something else was happening beneath the official data. Commercial imports of precious metals into countries with significant state-owned enterprises showed anomalies. China's official central bank gold reserves increased modestly. But total gold imports exceeded official reserve additions by substantial margins. Where was the difference going? Similar patterns appeared in silver data. Official statistics showed declining investment demand in some categories. Yet physical metal was disappearing from markets. Someone was accumulating at scale without leaving clear statistical fingerprints. The implications were profound. If governments were quietly stockpiling strategic metals while publicly maintaining confidence in fiat currency systems, it suggested they were preparing for outcomes they couldn't publicly acknowledge. The banking sector added another layer of systemic fragility. March 2023 had demonstrated that bank failures could still trigger rapid contagion, despite supposed reforms after 2008. Silicon Valley Bank, Signature Bank, and Credit Suisse had all failed within weeks. The response? Emergency liquidity facilities and rapid consolidation. The underlying fragility? Unaddressed. By 2025, the banking system remained vulnerable to the same fundamental problem: duration mismatch. Banks borrowed short and lent long. When interest rates shifted rapidly or depositors lost confidence, the mismatch created insolvency risk that no amount of capital requirements could fully mitigate. Precious metals demand surged during banking stress for one simple reason: they represented assets with no counterparty risk. Physical silver held in possession couldn't be bailed in, frozen, or subjected to capital controls. The geopolitical dimension intensified the monetary stress. De-dollarization had progressed from theoretical discussion to practical implementation. The BRICS nations had expanded membership and were actively developing alternative payment systems. Bilateral trade agreements increasingly settled in currencies other than dollars. Central bank dollar reserve holdings had declined from 72% in 2000 to below 58% by 2025. This wasn't collapse, it was gradual erosion. But gradual erosion of the world's reserve currency created ripple effects across every market where dollars had served as the pricing mechanism. Silver, priced globally in dollars, faced a peculiar dynamic. If dollar confidence continued eroding, silver's dollar price could rise simply from currency weakness, regardless of supply and demand fundamentals. For the treasury manager in Stuttgart, these systemic considerations crystallized into a practical framework. He needed to assess 3 scenarios and position accordingly. Scenario 1, mean reversion. Silver corrects to the $70-$75 range over the next quarter. Physical supply constraints ease as prices fall. Industrial users who waited benefit from lower input costs. Paper market technicals reassert. Normal commodity dynamics return. Probability, he assessed this at 25% possible, but requiring resolution of supply chain breakdowns and moderation of investment demand. Neither seemed likely in the near term. Scenario 2, range-bound volatility. Silver oscillates between $80 and $95 for 6 to 12 months. Neither bulls nor bears gain decisive control. Physical premiums remain elevated but stable. Supply gradually improves but doesn't normalize. Investment demand persists but doesn't accelerate. Probability, 45%, the most likely near-term outcome. Allowed time for supply chain adjustments, while monetary uncertainty kept investment demand elevated. Scenario 3, Acceleration higher. Silver breaks decisively above $95 and continues toward $110, $120. Physical shortages intensify. Premium explosion continues. Paper market price discovery fails completely. Monetary crisis elements become dominant over industrial commodity characteristics. Probability, 30%, lower than range-bound scenario, but significantly higher than historical norms would suggest. The probability reflected systemic risks that hadn't existed in previous cycles. His decision framework became clear. Lock in 3 months of supply immediately at current elevated prices. Establish relationships with secondary suppliers despite higher costs. Build inventory buffer beyond normal 2-week levels. Accept margin compression now to ensure production continuity. But his decision was operational. The strategic question facing long-term investors and business leaders was larger. The analyst had spent weeks examining the technical question: bottom or retest lower? He had built probabilistic models, studied historical precedents, mapped supply chain constraints. His conclusion challenged the premise of the question itself. Whether silver retested 75 hours or broke to 110 hours in the next quarter mattered far less than understanding the regime change and process. For 70 years, from the end of Bretton Woods in 1971 through 2020, monetary metals had been in a long-term bear market against financial assets. Central bank credibility remained largely intact despite periodic stress. Fiat currency systems functioned. Paper claims on wealth were generally trusted to retain value. That era was ending. Not suddenly, not through single catastrophic failure, but through grinding loss of confidence in the sustainability of debt-based monetary systems. Silver's move to $89 wasn't primarily about silver. It was about what silver represented in a world where trust in traditional stores of value was eroding. The physical disappearance wasn't a supply shock. It was people choosing tangible assets over financial claims. The premium explosion wasn't speculation. It was the market pricing counterparty risk. For existing holders, the implication was clear. Physical metals held for systemic insurance purposes should not be traded based on short-term price movements. The insurance remained necessary regardless of whether the premium seemed expensive. For new entrants, the challenge was different. How to gain exposure without buying tops? The answer lay in understanding that tops and bottoms mattered less than position sizing relative to overall risk. A 5% allocation to physical metals provided meaningful protection, even if purchased near cyclical highs. For business leaders, the requirement was adaptation. Systems built assuming reliable supply chains and stable monetary conditions needed redesign for environments where neither assumption held. The German Treasury manager made his decisions based on this framework. He secured supply. He accepted costs. He adapted. 6 weeks later, his competitors who had waited for better prices shut down production lines for lack of material. The market had rendered its verdict. The question was never whether $89 was a top or a bottom. The question was whether decision makers understood that the rules governing markets had fundamentally changed, and whether they would adapt before the system forced adaptation upon them.